Just making sure our live stream is starting. Okay, well, good morning and welcome to the Office of Tax Appeals. My name is Kenny Gast, and with me today are Administrative Law Judges Mike Lee and Hans Farmularo. As you know, this appeal will be live streamed on OTA's YouTube channel, so I would like to ask, I already did, the hearings team has started the live stream. Please note that OTA is not a court, but is an independent appeals body which is staffed by subject matter experts and is independent of any tax agency. Also present is our hearing reporter to my right, Ms. Mosky, who is transcribing this hearing verbatim. To ensure we have an accurate record, we ask that everyone speak one at a time and do not speak over each other. Also, speak clearly and loudly. When needed, Ms. Mosky or any panel member will stop the hearing process and ask for clarification to ensure proper transcription. After the hearing, Ms. Mosky will produce the official hearing transcript, which will be available on the OTA's website. The hearing transcript and video recording are part of the public record. All right, this hearing is expected to last approximately 3 hours, but we will take breaks as needed, and we must take a break no more than 90 minutes into the hearing, so we'll do that if needed, but hopefully before that. Any questions before we go on the record from either party? Okay, great. All right, why don't we go on the record? This is the consolidated appeals of Burch and Carden, OTA case numbers 230112266 and 230112267. Today is Tuesday, June 16th, 2026, and the time is 9:03 a.m. This hearing is being held in Cerritos, California, with the agreement of all the parties. My name is Kenny Gass, and I'm the lead administrative law judge for this appeal. With me today are Administrative Law Judges Mike Lee and Hans Farmularo. Can the parties please identify yourself by stating your full name, first and last, for the record, beginning with appellants?
Sure. Chris Campbell, Deloitte Tax, for appellants.
David Hahn, Deloitte Tax, for appellants.
Good morning, Ellen Swain for the Franchise Tax Board.
Leah Thyberg for the Franchise Tax Board, respondent.
Thank you. So the sole issue for today's case is whether appellants generated California source income from the sales of partnership interests that included amounts attributable to unrealized receivables and inventory items under Internal Revenue Code Section 751A. All right, going to the exhibits. I know we've had some correspondence related to that recently. So with respect to the evidentiary record, appellants have provided exhibits 1 through 6. FTB did not object to the admissibility of exhibits 1 through 5. However, FTB, and correct me if I'm wrong, Ms. Swain, did partially object to the admissibility of exhibit 6 related to an email dated May 24, 2019, from Mr. Campbell to FTB's Mr. Christopher Castleman. I'm going to overrule that objection. That will come in. Exhibit 6 does contain facts relevant to the background of this case, even though it is solely a legal issue. So therefore, these exhibits are entered into the record. So exhibits 1 through 6 are entered in the record. But I note that exhibit 5 is a tax article that will be considered only for purposes of legal argument. FTB provided exhibits A through E, letters A through E. Exhibits E and F were submitted untimely and after the June 4th, 2026 deadline in the minutes and orders, but they were submitted in response to appellant's exhibit 6. I will admit exhibits E and F as well into evidence since they are FTB declarations from the auditor and protest officer on this case that respond to appellant's exhibit 6. Appellants have not objected to the admissibility of any of these exhibits, and they've also waived their right to provide written questions for the declarants under OTA's regulation 30214B1 and 3. So All of FTB's exhibits are entered into the record, but I will note, as I did with appellant's exhibits, that exhibits A through D are various legal authorities and are considered solely for purposes of legal argument. Any questions there? I know I went kind of quickly. Okay.
No, Judge, thank you.
Okay. All right. With that, I'm going to turn it over to appellants for their presentation. I know you've requested 90 minutes, so whenever you're ready, please begin.
Thank you, Judge Gast. Okay. As you mentioned, this case involves a legal issue. Just make sure you can hear me okay. The facts are not in dispute. The legal issue is a selling partner's 751A ordinary income a distributive share of partnership income from a deemed sale by the partnership of Section 751A property? The answer to that question is clearly no. We phrase the issue this way because the FTB's entire determination in this case hinges on its reading of Section 751A as providing for a deemed sale of property by the partnership. And according to the FTB, this deemed sale generates income at the partnership level and therefore a distributive share of partnership income to the selling partners. The FTB has created a false premise. There is no deemed sale or distributive share here. And I'm going to go slowly because I know to try to help the reporter. But if I go too fast, just let me know. Okay, on the screen, we have Regulation 17951-4D. This is the starting point for the Franchise Tax Board and for refuting the FTB's protest determination, which is also the conclusion in FTB's legal ruling 2022-02. This is the regulation the FTB is relying on to treat the non-resident selling partners Section 751A ordinary income as a distributive share of the underlying partnership's business income. A selling partner's Section 751A ordinary income, however, is not a distributive share of partnership income. As a result, this regulation does not apply. The right answer in this case, and the answer that has governed every sale of a partnership interest prior to the issuance of the FTB's legal ruling for decades, is that the entire gain from the sale of a partnership interest, both the capital gain and the ordinary income, is income from the sale of intangible personal property that, in the case of an individual partner, is properly sourced pursuant to Section 17952. The FTB's determination in this case is wrong and must be reversed. The legal ruling is wrong for the same reasons. There's no shortage of instances of the State Board of Equalization, the OTA, and California courts declining to apply or even invalidate FTB legal rulings and TAMs when they are contrary to established law. That is what needs to happen here. In order to demonstrate the FTB's position on the law is wrong, we're going to start with some basic concepts of Subchapter K, though we realize that there are everybody on the panel is a real expert in Subchapter K. So David will do that in a minute. Then we'll discuss the plain language of Section 751 and applicable Treasury regulations, and then show the FTB is misreading these provisions. And at this point, I want to say the tax terminology is very important. When a tax agency makes a determination against a taxpayer or issues a ruling of general application on a highly technical legal issue like Subchapter K, as it applies to a common everyday transaction like the sale of a partnership interest in this case, you'd expect the agency to use correct tax terminology. That's the point of going through the concepts on the next couple slides. We'll also explain that you don't have to take our word for any of this. The D.C. Circuit Court of Appeals rejected all of the arguments that are being made by the FTB for exactly the same reasons that we have been submitting to the FTB since February of 2018, 6 years before the Rawak case was even decided. While there's absolutely no doubt that the FTB's determination in this case and in the legal ruling are wrong as a matter of law, there's also no doubt that the FTB's position regarding Section 751A is new and novel and first released to the public on July 14, 2022, 10 years after the tax years in this case. This position was not the law in 2012 and 2013, and certainly cannot apply to appellants in this case. As appellants have maintained with the FTB since 2018, during the audit, the proper avenue for the FTB to seek a change in the law would be to approach the legislature. The legislature could enact a special sourcing rule for Section 751A ordinary income. It did something similar for guaranteed payments in Section 17854. There are a lot of consequences the FTB has not thought through, and all of those things could be considered in a public rulemaking process. That would be the appropriate forum for considering whether a rule like this should be adopted in the first place. For all these reasons, the OTA should rule in favor of appellants. And at this point, I'm going to turn it over to Mr. Hahn.
Thank you, Chris.
I need to go back to the slide real quick. One more point. Sorry, to close the opening, so to speak, we had 17951-4D on the monitor because this is the provision the FTB, as I said, is relying on. This provision applies to source distributive share income of a partnership. And we said that the legal ruling creates a false premise because the legal ruling concludes, as we'll go through during our presentation, that 751A ordinary income is a distributive share of income from the partnership, which is what we have in our red text down there. So the point to start with is that everything that we're about to go through is going to show that 751A ordinary income is not a distributive share of partnership income. There is no partnership level income. And so this reg can't apply, and this reg must apply for the FTB's position to be correct.
Thank you, Chris. So we'll start with some very basic concepts of taxation of partnership level income under subchapter K of the Internal Revenue Code. Again, we understand that everyone on the panel may be familiar with the concept of distributive share income, but these basic concepts are critical to this case, and because the FTB's legal ruling and briefs at certain times do not use the correct tax terminology, and this causes confusion to the reader or the listener. So on this slide, we have a very simple example of a partnership with two partners, and to line it up with the facts of this case, the partnership would be Torrey Burch LLC. Assume it has $100 from operations, and this would be partnership level income. This partnership would report its income on a 1065 or a 565 or 568 in California. In this example, each partner would report its distributive share of the partnership's income. We have 50-50 equal partners in this example, so each partner would report $50 of the partnership's income. The partnership issues K1s to each partner reflecting this distributive share. And distributive share rules are generally found under Section 702 of the Internal Revenue Code, and the specific items included in a partner's distributive share are set forth in the 702 regulations. This is important as we'll get into when we discuss the Treasury regulations later on. So moving on to the next slide. Here we're showing the same partnership, but one of the partners, partner B, is selling his partnership interest to a new partner for cash. This is a sale or exchange of a partnership interest. The selling partner realizes gain equal to the amount realized less the partner's adjusted basis in his partnership interest. No income is realized by the partnership when the partner sells his or her interest. Again, lining it up with the facts in this case, JCBI sold its interest in Tory Burch LLC. JCBI, the partner, realized gain. There is no income within the partnership, Tory Burch LLC. And here we're just making the point conceptually that the taxpayer here is the owner of the interest, and the taxable event is a taxpayer sale or exchange of property, i.e. the partnership interest. There is no taxable event at the partnership level. And just to sum up the point of these two slides, again, these are very simple examples. There's partnership level income and there's partner level income. When a partner sells a partnership interest, in this case, when JCBI sold its interest in Tory Burch LLC, JCBI realized income. Tory Burch LLC did not. Indeed, the FTB does not contend that Tory Burch realized or reported any income as a result of JCBI's sale of its interest. This point of fact is one of the fatal flaws in the FTB's position in the case and in the ruling, and we'll come back to it later in our presentation. We also wanted to point out in the FTB's opening brief on page 7, where they write that the effective appellant's argument is that non-residents should not be taxed on non-realized inventory, notwithstanding the fact that California residents who would not be entitled to use Section 17952 similarly as a backstop are taxed on the same items. This is an incorrect statement. There is no leakage, as the FTB's statement suggests. There is no additional income for California to tax here as a matter of policy. Resident partners pay tax on their entire gain, capital and ordinary, when they sell a partnership interest. Non-residents are taxed to their state of residence in the same amount. Partnership business income from selling inventory and collecting unrealized receivables would constitute distributive share income to both resident and non-resident partners. So now I'll turn it back over to Chris, who will discuss the plain language of the statute.
Yeah, just on the last point that Mr. Hahn just made, California residents pay tax on their total income, which would include their total gain. Non-residents would not pay tax on gain from the sale of an interest other than to their state of domicile. That's what 17952 says, and that's the rule that applies usually across the board in the states. Partnership income, however, including income generated from selling inventory or collecting on receivables, that's partnership level income. And as the partnership operates and generates income, that income will be reported and taxed. It's reported in the distributive share of each partner's distributive share of that income will be reported at the time that's received. So that's just very separate from the taxpayer level income from selling an interest. So let's go to the plain language of the federal statute. Okay, so on the left of this slide, we have 751A, text of 751A, and on the right side, we have the text of 751B. 751A applies when a partner sells a partnership interest. That's what applies in this case. 751B applies when a partner receives a distribution of property or money from the partnership itself. 751B involves a transaction between a partner and the partnership. 751A is a transaction between a partner and a third party, like on the prior slide. So sticking with 751A, when a partner sells a partnership interest, in this case when JCBI sold its interest in Tory Burch LLC, JCBI realized gain measured by the amount realized and its adjusted basis in the interest. Under Section 741 of the Internal Revenue Code, not shown, The gain is capital gain because a partnership interest is a capital asset. Section 741 says, in the case of a sale or exchange of an interest in a partnership, gain or loss shall be recognized to the transferor or partner. Such gain or loss shall be considered as gain or loss from the sale or exchange of a capital asset, except as otherwise provided in Section 751 relating to unrealized receivables and inventory items. 751A on the slide says, the amount received by the selling partner in exchange for unrealized receivables or inventory of the partnership shall be considered as an amount realized from the sale or exchange of property other than a capital asset. Not to get ahead of ourselves, but Congress's use of the same phrase, shall be considered as, in Section 741 and Section 751A, is important to demonstrating that the FTB has misread the statute. The D.C. Circuit Court of Appeals makes this point very well in Rawat. We'll come back to it later. So what 751A does is it recharacterizes a portion of the selling partner's capital gain as ordinary income. The amount of ordinary income is the amount attributable to the partner's interest in the partnership's 751 property. So why is this the case? Again, when a partnership sells inventory or collects receivables, the income realized by the partnership is ordinary income. And again, that ordinary income will flow through to the partners as distributive share income when it's received. In this case, Tory Burch LLC sells inventory and collects on receivables from its customers. Tory Burch realizes income, and this income is passed through to its members. Distributive share income flows through on K1 to each member. So what is 751A doing? 751A, well, under these rules, under the partnership sub-K rules, it was possible for partners to contribute ordinary income property to a partnership and then turn around and sell a partnership interest. Under federal law, the sale of the partnership interest generates capital gain, as we just discussed. So I have holding assets that would have generated ordinary income. I contribute them to a partnership. I sell my interest. And now I have capital gain, and I've just converted what would otherwise be ordinary income into capital gain, which under federal law was taxed at much lower rate. 751A was enacted in 1954 to prevent partners from doing that. So the whole point is, when I sell my interest in the partnership, the portion of that interest, the amount that I receive from my buyer, a portion of that is going to be treated as ordinary income and taxed at a higher rate for federal tax purposes. That was the solution to that specific problem. The partnership, of course, in that example, in this situation, is not selling inventory or unrealized receivables, and there's no deemed sale of property at the partnership level. This is simply a mechanism for treating a portion of the selling partner's income as ordinary income to be taxed at that higher rate as opposed to capital gain. And again, the partnership will continue to earn income from operations in the normal course of its business, and that income will be taxed to the partners as it's earned. And I'm going to apologize in advance because I know this is repetitive, but we're going to be repetitive. So again, apologies in advance. So what happened here? 751A applied. JCBI realized gain when it sold interest in Tory Burch in 2012 and 2013. A portion of this capital gain was recharacterized as ordinary income. Therefore, JCBI reported both capital gain and ordinary income when it sold these interests. Okay, so go back for a second now to the FTB's position on this point. FTB's position is that the 751A ordinary income, the ordinary income that JCBI is reporting under the plain language here, is distributive share income, a distributive share of Tory Burch LLC's gain from the sale of partnership property. So here's 751A plain language, and let's go back for a second to the first slide. Again, this regulation applies only to source a partner's distributive share of income. And subsection 2, each partner's distributive share of the partnership business income apportioned to this state is income derived from sources within this state. The FTB's position in the determination, in this case, in the legal ruling, is that the 751A ordinary income is, and we have text showing what some of the language, is a pro rata distribution or distributive share to the partner of gain or loss items of the partnership. Well, again, from subchapter K perspective and just getting terminology right, there's no distribution. It's a distributive share, first of all, but there isn't a distributive share at all in this case. So by finding on using the language of 751A, saying that there is a distributive share, it forces this rule to apply, because this rule then would operate to source partnership business income from selling inventory and receivables as, in part, California source income. And again, Tory Burch LLC every year is selling inventory, collecting on receivables, and all of that income from the inventory and receivables that we're even talking about here is reported and taxed to the partners, on Schedule K-1s. It's just, none of this applies when you sell an interest in the partnership. Okay. So let's go look at 751B, which makes this abundantly clear, just purely from looking at statutory language and the words enacted by Congress and the legislature. So Section 51B applies when there's a distribution from the partnership to a partner. This is a sale or exchange transaction between the partner and the partnership. The whole point of lining these two provisions up next to each other is so that we can compare the statutory language. 751B, in the distribution between, from the partnership to a partner, such transaction shall, under regs, be considered as a sale or exchange of such property between the distributee and the partnership as constituted after the distribution. That's very different than what 751A says, which is simply that the selling partners, an amount of the selling partner's income, it shall be considered as an amount realized from the sale or exchange of property other than a capital asset. Again, 741 treats the entire amount in general as capital gain, and this provision, 751A, recharacterizes a portion of that to ordinary income. That's all it does. It only operates at the partner level. There is no partnership level transaction. There's no partnership level income. There's no distributive share income, period. 751B, on the other hand, there is. And this will become very clear in the regulations. And this is important because the regulations have specific references to the distributive share rules for 751B. There are no such rules in 751A. And so again, Congress and Treasury, IRS completely understand and have very clear rules demonstrating that there's distributive share income in a 751B transaction, but there is not in a 751A transaction. So let's move on. Just one more point. So again, just focus on this slide. The language, the bold language, is there to show that Congress and the legislature, which incorporated this in California, knows exactly how to provide for a deemed sale when it wants to do so. Okay.
Thank you, Mr. Campbell. So to that point, FTB's position in this case is that 751A creates a deemed sale of property by the partnership. The IRS made this exact same argument in Rawat, that Section 751A provides for a deemed sale of property by the partnership, and the D.C. Circuit Court of Appeals emphatically and very thoroughly dissected and rejected the IRS's position based on the plain language reading of the statute. So here we have some excerpts from the Rawat case. In effect, the Commissioner asked us to interpret the clause shall be considered as an amount realized from the sale or exchange of property other than a capital asset in 751A to mean shall be considered as an amount realized from the sale or exchange of such property. But Congress used exactly that locution in the very next provision of the code, Section 751B1. And the court concludes, we cannot conclude that Congress intended to convey elliptically in 751A what it said far more directly in the adjacent provision 751B. The plain language of the statute is but one of many things that demonstrate that 751A does not provide for a deemed sale by the partnership and therefore does not generate distributive share income to the selling partner. The regulations make it abundantly clear that there is no deemed sale. Again, absent a deemed sale by the partnership, there is no distributive share income to source pursuant to California Regulation 17951-4.
This one. Okay. So the next couple slides are going to be the regulatory provisions that are important here. I'm going to stop though and say neither the determination in this case nor the legal ruling actually cite or quote to or cite other than one cite to the -A1 reg, but any of these provisions. So as we'll see, these regs for both under 751A and B, clearly explain what happens when you have either a sale of a partnership interest or, a distribution that is a 751B transaction. Those rules really, again, if they had been looked at or cited by the ruling, they wouldn't, we wouldn't be here. Let's put it that way. So 751A, the regs under 751A start with the one on the screen, -1A. This regulation generally restates the code section, but just goes on to say that, there's an amount that's going to be considered as an amount of ordinary income, and that the remainder of the partner's income is capital gain. That's what that last sentence says. And what's important, as we'll go through the next couple regs, is that this reg omits any reference to Section 702, which is the distributive share section of the Internal Revenue Code. And under 702, in the -1 reg of under 702, the items of partnership income, gain, loss, or credit that must be included in a partner's distributive share are listed with great specificity. 751A ordinary income is not in that list. However, 751B income is, because under 751B we have a distributive share income. Under 751A we don't. So that's important. So let's go to the next slide. The second section of the regulation under 751A is simply explaining how you compute the amount of ordinary income, the selling partner's ordinary income. And it says the income or loss realized by a partner is the amount of income from 751 property that would have been allocated to the partner if the partnership had sold all of its property in a fully taxable transaction for cash immediately prior to the partner's transfer of the interest. The fact that the amount of the selling partner's capital gain is considered as ordinary income is computed by reference to a hypothetical sale is not the same as saying that there's a deemed sale. So as to this computational point, it's one of the arguments the IRS made in Rawat. The DC Circuit said, look, running a calculation based on a hypothetical inventory sale doesn't change the fact that the partner sold a partnership interest, not inventory. So that's, again, comparing this to 751B, which is, what we're going to be doing. This is a calculation, not an actual deemed sale. Again, the third section of the regulation under 751A just tells you how to report the ordinary income. A partner selling or exchanging any part of an interest in a partnership that has any Section 751 property at the time of the sale or exchange must submit with his income tax return for the taxable year a statement setting forth separately the following information: the date of the sale, the amount of the 751A ordinary income, and the amount of the 741 capital gain income. Again, the Treasury regulations require the selling partner to report this information because it is the selling partner's income. None of this information is contained on a K-1 because the amount of the partner's ordinary income and capital gain is not a distributive share of partnership income. So let's compare all of this with, again, what's going on in 751B and those regulations, because this is the exact same code section and the exact same set of regulations where, on the one hand, you've got an amount considered as ordinary income, and on the 751B side, we have statutory language creating a deemed sale and a partnership sale or exchange and partnership income and a distributive share. I mean, that's just sort of critical to point out. Let's go to the next one. So these are the regs under 751B. There are two regs because there's two parts, two different transactions that 751B covers, but they say the same thing. So on this slide, this applies to a distribution of Section 51 property. The reg, like the statute says, this transaction shall be treated as a sale or exchange of such properties between the distributee partner and the partnership. At the time of the distribution, the partnership realizes ordinary income or loss on the sale or exchange of Section 751 property. Goes on to say, in computing the partner's distributive shares of such ordinary income or loss, the income or loss shall be allocated only to partners other than the distributee and separately taken into account under Section 702A8. Again, 702, the regs under 702 specifically require a partner to take into account, quote, his distributive share of the following items. There's a long list, and then it says income, gain, or loss to the partnership under Section 751B. There is no reference to 751A because, again, there is no distributive share income in a 751A situation. The next slide is says the exact same thing. It's just, the context isn't a distribution of 751 property. It's a distribution of property or money in exchange for the partner's interest in the partnership's 751 property. Again, that's a sale or exchange, and the same language in this regulation is on the prior slide. Okay. The FTB understands the significance of Section 702 and the 702 regs. 702 is discussed on page 3 of the FTB's legal ruling, but the ruling fails to acknowledge any of these regulations and fails to acknowledge that 751A ordinary income is explicitly excluded, to put it that way, from, under the distributive share regs. So again, apologize again for being repetitive, but all of this is again showing that under 751A, a selling partner is not receiving a distributive share of partnership income. There is no partnership level income. And again, the FTB premise is that 751A provides for a deemed sale and a distributive share of income to the partners, which then allows FTB to apply 751-4D. That doesn't apply here. So let's turn to you.
Thank you, Mr. Campbell. So as we just discussed, the FTB's position is that when a partner sells a partnership interest, the 751A ordinary income is a distributive share of the partnership's California business income. So per the FTB, a portion of a non-resident selling partner's gain constitutes California source income, while the remainder of the balance, the capital gain, constitutes income from the sale of an intangible. So at this point, we'll discuss what the law was, is, and continues to be regarding the nature of the income resulting from the sale of a partnership interest in California. There's no question that a partnership interest is intangible personal property. A non-resident's gain from the sale of a partnership interest constitutes income from the sale of intangible personal property. The law on this is too well settled to warrant further discussion. See Ames and the cases cited in footnote 2 of our supplemental opening brief. The ruling itself also acknowledges on page 2 that section 17952 is the statute that applies to source a non-resident's income from the sale of a partnership interest. You can see on this slide the language of section 17952, which says, for purposes of computing taxable income of a non-resident or part-year resident, income of non-residents from stocks, bonds, notes, or other intangible personal property is not income from sources within this state unless the property has acquired a business situs in this state. A non-resident's income from the sale of a partnership interest is the entire amount realized from the sale. Section 17952 operates on the partner's income from the sale and encompasses the entire amount of the selling partner's income, regardless of the character of the income for federal income tax purposes. So put differently, the fact that the selling partner's income is, for federal income tax purposes, a combination of capital gain and ordinary income does not have any effect on the application of 17952. This was, is, and continues to be the law. The partnership interest sales in this case took place in 2012 and 2013. Appellants correctly reported the entire amount of the gain from the sale of the partnership interest, both capital gain and ordinary income, as income from the sale of an intangible sourced to their state of domicile. So to sum it up at this point, applying the law as it exists, 751A ordinary income is not a distributive share of partnership income. Regulation -4D does not apply to appellant 751A ordinary income because this income is not a distributive share of Tory Burch LLC's income from a deemed sale of 751 property. The entire amount, again being repetitive, of appellant's income is income from intangible personal property sourced pursuant to 17952. And as mentioned earlier, as Mr. Campbell mentioned earlier, the partnership will eventually realize income when it does sell 751 property, and this income will be taxed to the partners at that time. Subchapter K does not create a deemed sale of this property when a partner sells his interest in that partnership. If it did, it would be clear in the rules just like it is clear in section 751B.
Okay. Thanks, David. Everything we've just presented is based on federal and California statutes and regulations that have been in existence for decades. 751 was enacted in 1954. 17952 is a codification of the Mobilia common law doctrine going back hundreds of years. The FTB is fully aware of the history of these laws. Appellants filed their returns in accordance with these laws as they're required to do. And I'm going to take one more moment to go back to the text of 17952 because it's something I know many of us deal with every day, and there's a lot of cases on it. But this section has, as it always has, operates on income of non-residents from intangible personal property. There's, again, more than too many cases to cite that deal with sales of partnership interests. Sales of partnership interests are sales of intangible personal property. The income realized by a non-resident partner is the income sourced under this section. It does not matter that the income is capital and ordinary for federal income tax purposes, and it never has. Again, these rules have been around for decades, and until this legal ruling, as we'll see later, the FTB has never applied the law this way. You could not file a return the way that the FTB is claiming that we should have filed a return. That's another way to look at this. I think that's super important. Like, you simply could not, and the FTB's guidance, we'll see at the end, changed after it issued the legal ruling. But at the time of these transactions, and again, going back decades, just the way we all know these laws work, you could not have filed a return this way. You still can't. Okay, so July 14, 2022, about 10 years after the sales in our case, the FTB issues legal ruling 2022-02. The position taken in the ruling is the first time, to the best of our knowledge, that FTB publicly took the position that 17952, quote, is not sufficient to source the entirety of the sale, end quote, and that a selling partner's gain from the sale of a partnership interest is, under California law, partially gained from the sale of an intangible and partially a distributive share of partnership income. Of course, even saying that is difficult because my income is not, from selling, is not distributive share income. We have the key statements from the ruling on the slide, and I'm going to read some of them out loud just because, to point out, and sometimes hearing it is better, that they are completely contrary to what the statute provides. Again, so the second one, the deemed sale of the IRC 751 property, which is treated as if having been sold by the partnership immediately before the transaction through the operation of Section 751, is not treated as a sale of intangible or an asset sale by the transferor partner. But again, referring to it as a deemed sale, treated as if having been sold by the partnership. And then the next one continues, the proceeds attributable to the deemed sale of the 751 property are treated as a pro rata distribution or distributive share to the partner of gain or loss. Well, okay, first of all, there's no deemed sale, but they're trying to create a deemed sale so that you can have a distributive share of the partnership income. And just, and again, as a side on the terminology point, there are no proceeds to a deemed sale, and there's no distribution of anything in any of this, so that's just kind of confusing, which is something it's just difficult to read. Okay, so then the ultimate conclusion of the ruling is the distribution, or distributive share really, therefore, is income from a trade, business, or profession to be sourced pursuant to Regulation 17951-4. As we just witnessed, the FTB has reverse engineered a distributive share of income where there is none. That's it for this case. I mean, there's no distributive share here. There's no income to source. That's, that answers the question. Okay, so that's the legal ruling. Just go back for a minute to the determination letter. The hearing in this case, so this is July 14, 2022. the hearing in this case occurred on April 21, 2022. 3 months later, on July 19, 4 days after the hearing, after the legal ruling came out, protest officer sent the appellants a copy of the ruling, essentially as a preliminary determination, said, hey, look it over. That was our Exhibit 6. The determination letter was then sent on November 4, 2022, and it generally relied on the ruling as authority. But it has a couple other statements in it that we want to say on the record. According to the protest officer, appellants 751A ordinary income, quote, should be treated in the same manner as typical distributive share, which consists of business income. Okay, again, there's no law that allows the FTB to, quote, treat the selling partner's gains as the partnership's business income. And the fact that that determination is phrased as an opinion, that taxpayers' gains should be treated in the same manner as distributive share income, really just proves the point. When we read that, I'm not sure there's a determination there. I feel like it's an opinion. So I think, in our view, the FTB's opinion that the selling partner's gains should be treated as business income is not a determination to begin with, and it's certainly not a lawful basis for supporting a determination against the taxpayers in this case. That's what it says. It's an incredible contention. The plain language of the section 917-952 operates, as it always has, to source the entire amount of a non-resident individual taxpayer's gain or loss from the sale of a partnership interest. We've gone through that, so to be repetitive, it applies to income of non-residents from intangible personal property. The selling partner's income is the entire amount of the income, regardless of whether the amount is treated as capital and ordinary for federal income tax purposes. Okay. That plain language is simply incapable of supporting the FTB's new argument. And the fact that the insufficiency has never been identified before by the FTB, the State Board of Equalization, the OTA, any scholarly articles, as far as we can tell, not to mention the fact that the FTB's tax returns and instructions do not identify this insufficiency or provide directions for treating a portion of a taxpayer's gain as distributive share income, also should ring alarm bells. No amount of the taxpayer's gains in this case is distributive share income. Again, the entire amount is sourced pursuant to the plain language of 17952. By the way, there's also no problem to solve here. As we alluded to before, all California source income is being taxed by the rules as they exist. These rules work perfectly as written. Gains realized by selling partners, both ordinary and capital, are taxed to their states of domicile, subject to business situs, exceptions here or there. And income realized by the partnership, the operating income, is apportioned and taxed as business income when it's realized by the partnership. The FTB's ruling and the decision in this case actually caused way more problems than they're trying to answer. If the rule were as the FTB says, then there'd be many other tax consequences. And one, the language in the 751A regs and the 702 distributive share regs on the federal side also would, need to provide for the result that they're seeking. But if they were correct that this is what the law is, then there'd be consequences on the corporate side too. There are no, when a corporation sells a partnership interest or a non-unitary partnership interest, you would think that that those rules would then also need to explain how the ordinary income piece is business income, notwithstanding that the rest of the corporation's gain on the sale of the interest is, non-business income. But there are no statutes or rules that explain how any of that would work. Okay, again, so the proper way to address this problem, if it's a problem at all, would be to take it up with the legislature, as we said at the beginning. In a legislative process, all the nuances and effects of creating a new sourcing rule could be considered in a public forum, and all the unforeseen things that I can't even contemplate at this point in time could be, dealt with public comments and investigation. That's what the whole legislative process is for. That's not what happened here.
So we just wanted to go back to this slide showing regulation -4D. So you can now see it's obviously reverse engineering, and there's simply no distributive share income in this case. Again, the FTB's position in the ruling is completely dependent on the existence of a distributive share of partnership income, and we've already covered 751A is not or does not provide for a distributive share. So the FTB's position simply fails. The FTB's main support is the computational provision that Mr. Campbell went over under the Treasury regulations. The computational provision, or the computation provision, doesn't create a deemed sale. It simply tells a partner how to compute the ordinary income amount. And as we saw in 751B and its regulations, there is a deemed sale, and those rules specifically provide distributive share income to the partner. So just to close the loop on this, there isn't room for interpretation here, and we'll see that the D.C. Circuit Court addressed all of these points in Rawat.
Okay, so the good news, judges, is you do not have to take our word for any of this. The FTB's arguments in this case are nearly identical to the arguments made by the IRS in the Rawat case. And the D.C. Circuit, as we said earlier, thoroughly, dissected and rejected all these arguments. So, David, why don't you go through those slides?
Yeah, so sometimes hearing things are better than just reading it. And just to read a couple excerpts into the record to show how the FTB's arguments mirror the commissioners in Rawat. In Rawat, the commissioner argued that 751A deems the gain Rawat realized on the sale of her partnership interest to be from the sale of that inventory. And the commissioner urges us to read 751A's critical language shall be considered as an amount realized from the sale or exchange of property other than a capital asset, as a reference back to the two kinds of property listed above it, inventory and unrealized receivables. In his judgment, 751A should be read to say that inventory gain shall be considered as an amount realized from the sale or exchange of inventory. And the FTB, in its legal ruling, wrote similarly, the operation of Section 751 therefore necessitates that the sale of partnership interest be treated as two distinct transactions, one in which the intangible partnership interest is sold by the partner, and one in which 751 property is treated as sold by the partnership, leading to a deemed distribution to the partner. And here we have the DC Circuit Court's conclusion, where they write, the pivotal clause is the last one, shall be considered as an amount realized from the sale or exchange of property other than a capital asset. The court found that these mean shall be considered as ordinary income. These words do not mean, as the commissioner argued, that the selling partner's 751A ordinary income shall be considered as an amount realized from the sale or exchange of such property, which is what the FTB argues here. In other words, the plain language of the statute answers this question. There is no deemed sale or exchange of property, yet this is what the FTB's legal ruling says. And again, we're repetitive, but Rawat's analysis is conclusive and determinative here. Yes, this is a federal case, But the premise that underlies the IRS's arguments in Rawat is the exact same premise used by the FTB in this case. The IRS's position on the international sourcing rules was dependent on 751A providing for a deemed sale of partnership property. The FTB's position on the California sourcing rules is entirely dependent on 751A providing for a deemed sale of partnership property. That produces a distributive share income to be sourced under Dash 4D.
Yeah, in other words, so all the arguments we just made, which is all to refute the FTB's position in this case, they're the exact same arguments that the IRS was making and the exact same analysis that the DC Circuit uses to debunk those arguments applies here. It's directly on point. All that matters is the 751A premise. And once that's dispensed with, we have no distributive share income to begin with, which is everything that we're saying. So we're almost done with our opening. Look, outside the plain language of 751A and the regulations, and using Rawat to understand it all, answers the question here. Demonstrates that appellant's position is right, demonstrates that the protest determination is wrong, demonstrates that the legal ruling is wrong as a matter of law. But there's a few other things that are worth talking about. The FTB's ruling and determination letter, they don't point to any authority at all that's in existence prior to the ruling for the proposition that under California law, the entire amount of a selling partner's gain from the sale of a partnership interest is, sourced in the way that they're saying. The one case that they cite to is Appeal of Bentz from 1979, which they think supports the idea that 751A ordinary income is a distributive share of partnership income, or at least that's what they want it to say, and that ordinary income is not sourced by 17952, but that is not what Bentz says. Bentz isn't even a sourcing case. Bentz involved resident taxpayers who sold a partnership interest and realized gain, and they reported the entire amount of gain as capital gain. They didn't even apply Section 751A. Again, these are residents. They're taxed on their worldwide income. In California, the source of the gain was never an issue. But they reported the entire amount as capital gain. Under California law at the time, taxpayers were allowed to deduct a portion of their capital gain income. So by deducting this entire amount of gain, they reduced their taxable income, greater than they should have in California. The taxpayers in Bentz did not treat any of their gain as ordinary income, so their deduction was overstated. So the FTB came in, they said, hey, you didn't apply 751, your capital gain deduction needs to be reduced because a portion of your gain was ordinary income. You only get to deduct the capital gain piece. So there were specific rules that dealt with capital gain and ordinary income back then. So the discussion of all that in Bentz provides no support for the FTB's position that 751A ordinary income is distributive share income to begin with. And it only goes to show that the FTB and the SBE and everybody for that matter understood that, back then what the law is just that you get a deduction for capital gain but not ordinary income. And certainly there's nothing in that decision that supports this distributive share, conclusion. The FTB also relies on, in the determination letter at least, a Wisconsin tax publication, which we addressed in our briefs. But it's worth bringing up here. That Wisconsin publication tells non-resident partners to treat a portion of their gain that's attributable to partnership inventory actually located in Wisconsin as Wisconsin source income, and also says that amounts attributable to unrealized receivables aren't taxable in Wisconsin. The publication doesn't go into an analysis or claim that there's a deemed, sale and a distributive share. it's just a publication that's asserting and telling taxpayers, hey, and again, I don't know what the actual law is in Wisconsin, but all that does is say, hey, we want you to treat an amount attributable to your inventory that's actually here as Wisconsin source. Okay, that has nothing to do, it doesn't support anything that, California is saying here. And again, I'm just going to come back and say, step back. The FTB's reliance on a clearly inapplicable SPE case from 1979 and a Wisconsin publication as support for a position that dramatically changes the law that applies to an everyday transaction is shocking. As that Exhibit 6 shows, when this position first came about in a response in an audit report that we got in 2017, and we started communicating on this with the FTB, appellants pointed out that, hey, there's an Illinois ruling from 2011 that directly addresses this issue. Some taxpayer had asked Illinois to rule that the 751A ordinary income should be sourced to Illinois as a portioned income. The Illinois Department of Revenue rejected that. The ruling reads a lot like Rawat. The ruling reads a lot like what we've been saying all along. So they rejected the very position. The FTB is aware of that ruling, just like they are of Wisconsin publication and Bentz. And again, they don't mention that. So all of this has just been brewing for the last, out of the public eye for the past, since 2017 or 2018. And again, relying on Bentz and the Wisconsin publication in this case, to get this dramatic of a result and, change the way 17952 applies after all these years is just kind of, again, as I said, shocking. Okay. All right, to sum it up, I think we're summing it up here. Okay, Section 751 has been in the law since 1954. Partnership interests are sold every day. We respectfully submit that the FTB could not, with a straight face, contend that Section 17952 has always applied only to the capital gain realized by a selling partner, and that it is not applied ever to a selling partner's ordinary income. If that's what the law is, that's what it's always been. It's not. And further, that the ordinary income under 751A is distributive share income. It's never been the case. If the FTB were correct that this is and was the law, one would expect the law to be crystal clear. The partnership and personal income tax forms and instructions would explain that a selling partner's distributive share of 751 ordinary income would need to be reported as California source income. Surely the cases involving sales by non-residents of partnership interests would discuss the quote-unquote bifurcation of the selling partner's income between intangible income and a distributive share of the partnership's income. They do not. And you'd see discussion of the corporate rules versus the personal rules, because there would be differences. We don't see that. Prior to the issuance, let's go to the last slide. Prior to the issuance of Legal Ruling 2022-02, the FTB's residency and sourcing manual had one line for decades. Sale of a partnership interest is considered a sale of an intangible asset. See Ames. Okay. And then again, that's what it was there when these transactions occurred. A few months after the legal ruling came out, and about the same time the determination letter was given to us, the final letter was given to us, the manual was updated, and now it contains this language on the screen. Sale of a partnership interest is considered a sale of an intangible asset, see Ames, and then goes on to basically parrot what's in the ruling, that, 17,952 now is all of a sudden insufficient to source the entire amount of the non-resident's income. The ordinary income piece is something to be sourced under as distributive share income under Dash 4. So again, I think all this just goes to show that this is a change in the law. They're seeking to change the law. This is a change in the law. There would have been, certainly in 2012 and 2013 when these transactions took place, this didn't exist for us or for, again, this is such a common transaction, anybody else. There's no indication in any authority anywhere, and the authorities are all to the contrary, that 17,952 did in fact source all of a partner's gain. There's nothing about this in Ames or Bentz or Metropolis or Smith for that matter, all of which deal with sales of partnership interest. There's 50 cases before that. I think we already covered that, didn't we? Yeah. Okay. Okay, so at this point we will conclude and save anything for rebuttal. But our closing comment is that without a distributive share of income, we have no California source income to source under this reg, and that's where we stand.
All right, thank you very much. What we'll do at this time is take a 10-minute break. So it's 10:12. We'll come back at 10:23, and we'll start with panel questions for appellants, if any, and then we'll move to FTB's presentation. We'll go off the record now. Thank you. Okay, why don't we go back on the record? And at this point, I'd like to turn it over to my co-panelists to see if they have any questions. I'll start with Judge Lee.
Thank you for your presentation. I don't have any questions. Thank you.
Okay, and Judge Formularo?
Yes, thank you for your presentation. It was terrific. I do have a question. So I understood you to say that 751A is what controls the question here. It's a matter of statutory construction. And you said there's no room for interpretation. However, I do understand that what FTB is going to argue is that the tax court viewed it differently. And they looked at that exact same clause that you mentioned, the shall be considered as an amount realized from the sale or exchange of property other than a capital asset, and interpreted that same language differently, and in fact held for the position that FTB is asking us to find for today. I would like to hear your position regarding the tax court's interpretation of that statutory language. As you know, the D.C. Circuit case is persuasive, and the tax court case is also a persuasive opinion for purposes of OTA. There is a Golson rule in the tax court, which I know that you're familiar with, so the D.C. Circuit Court case would be binding in the D.C. Circuit on the tax court, overruled it for purposes of the D.C. Circuit, but not for the rest of the circuits within the country. So again, in my view, we have two persuasive opinions. They are both interpreting the same statutory language. They're coming out with two opposite conclusions. And I heard all the arguments you gave for why the D.C. Circuit's statutory construction analysis is correct. I would like your view on why the tax court's statutory construction analysis is incorrect.
Yeah, good question. Thanks, Judge Famularo. Let me answer that probably a couple ways. Number one, this is a California tax case. The fundamental issue here is the construction of California statutes. The law that applies here, and I'll get to your question, the law that applies here is 17952. That is the statute, codification of the Mobilia rule, that we all know applies to the sale of intangible personal property, which includes the partnership interest. So it is putting a heck of a lot of weight on a reinterpretation of that provision after decades, at least since 1954, let's say, to somehow reverse engineer, as I showed, an argument that we're not in that statute. How do we get out of 17952? Because that is what applies. Like, we weren't, when we got this audit report, by the way, in 2017, we were shocked. We're like, I've never seen this before in my life. I've been doing this 25 years. Sorry if I'm going fast. And Rawat wasn't even in existence at that time, okay? So these arguments, didn't exist. The position didn't exist. 17952 is a California statute that we all know applies and always has applied, okay? That's the starting point. You then have the whole concept of distributive share income, which is the regulation. The way to get out of 17952 is to say, oh, we have distributive share income. How do we have distributive share income? Well, somebody, again, there's lots of emails, by the way, in the audit file and records of conversations that occurred outside, in this audit about what was going on behind the scenes. That's all there. But at some point, somebody says, oh, well, maybe we can figure out a way to create something to source under 17951-4. And I get it, just like in the tax court, in the international sourcing provision, and the argument here, I don't want to make it for them, but basically they're saying, look, this is attributable to 751 property. Therefore, one attorney told me once, it seems like there's something that could be sourced, right? You're answering, but that's a problem that, like, A, needs a solution that would be legislative, A, but it's also not a problem because at the end of the day, the partnership is going to pay tax. The partners are going to pay tax on that income when the partnership realizes it. In effect, telling the selling partner that they are paying tax on a portion of this income as if the partnership realizes it. On the FTB's position, it's like the partnership is realizing it, But the reality is that is going to be realized and taxed to the other partners when it's actually realized, right? And there's no mechanisms in 751A, as I think you know from sub K experience, to shift basis or specially allocate, only to the selling partner. Obviously, 751B and the regs there allocate to the other partners, right? I mean, it's very technical. So to kind of get back to your question, the point is, I get it. You've got two competing opinions under federal law dealing with that specific situation. I will say that the unanimous decision of the D.C. Circuit, written by the chief judge, who's Sri Srinivasan, who is also a Supreme Court nominee and the Solicitor General and somebody that I worked for many years at my former firm, probably the smartest guy I've ever met. That opinion is so well written and is just so convincing that when I look at the analysis in the tax court decision, I'm just like, well, that's clearly the right answer. And also just from playing in the sub K sandbox for 20 years, I feel like that's a much better decision. So from a question of what's binding on the OTA, I get it. You've got two competing positions. I can't sit here and say as a tax professional academic that, I know better than anybody else. But what I can say is the DC Circuit's case opinion is way more persuasive in my view. And as far as the issue before the OTA is concerned, which is, do we have a distributive share of income? And remember, this isn't, I think importantly, the tax court and the DC Circuit, we're dealing with the issue, again, it's an international sourcing issue. It was solved legislatively during the pendency of the case. That issue doesn't exist anymore. But nonetheless, the discussion and the statutory construction of 751A is important and relevant and was more persuasive, in my opinion, in the DC Circuit. Here, again, this issue, sales of partnership interests are everyday transactions. The law, the sourcing laws that apply to that have to be clear. They always have been. They need to be in a statute. They are in a statute. So in 2022, come in, 10 years after 2012 for that matter, and say that, oh, here's a potential argument that could be convincing, to treat some of this partner's gain as, distributive share income. And then to say that, we find support in a tax court case that just came out, and all of a sudden we're going to use that and the more flimsy stuff like Bent's to support a massive change in the law in the application of a statute here. My first comment was, this is way too much, I'm trying to phrase it the right way, way too little support to begin with to affect such a gargantuan change in the law that actually exists. Like, we can sit here and argue about which opinion is, more well-reasoned, but that doesn't change the fact that we just don't have distributive share income. But if we did, it would have to be damn clear in the statutes, and California law would have to be super clear to say that this is what you have and this is how you source it. But that didn't happen until the legal ruling. Like, that doesn't exist before then. Does that make sense? Sort of, hopefully.
It does.
So-
No, I appreciate that. I assume that you're getting also to the point of my question again, which was like the way that the tax court interpreted that phrase. And they looked at the word property in particular and said that could mean no more than just a non-capital asset. It could mean multiple pieces of property, and they interpreted that to mean that 751A was more than just characterization, that it supported the FTB's position that there is a deemed sale of inventory or collection of unrealized receivables. And so I don't know if you have any views specifically to address the way that the tax court interpreted that phrase.
Well, I guess I would, on that point, all I can say is I don't agree that that's a persuasive reading of the statute. I mean, it's very, putting aside what the DC Circuit said, and again, I would ask everybody to remember, if you were just to go back and look at all the back and forth submissions in this case, they all occurred before Rawat. So we have lots of good discussion of all these issues, prior to any commentary by the tax court. But the symmetry in the language between 741 and 751, which is, hey, capital versus ordinary, is considered as, and the whole point of 751A, which was to prevent, people from forming partnerships, selling and getting ordinary income. I would ask, I don't know if the tax court's interpretation is really consistent with just the fundamental problem that 751A was trying to solve. And I feel like that's what the DC Circuit, came in. They said, look, here's what the problem was. They solved it, and it's pretty clear that they're just making it ordinary income because that's what would have otherwise been realized had they sold it. And they even did the computation that way. I don't know what more there is to say, because otherwise I feel like we're reading too much into the words here. Like, again, as we say, there's not much to interpret. But I would ask, in the whole context, we start with not as a, when I say 751A is determinative, I mean the construction is but the reason it is you have to get you have to find a distributive share of income. So absent that, that's really, it's a California issue to begin with. Sorry, I just started there, but.
No, I appreciate that. Thank you. No, you did answer my question, and I appreciate it. So the other thing I just wanted to follow up on was the regulation under 751. So 751-1A2, which deals with the hypothetical sale. The D.C. Circuit, in its opinion, said that it was a reasonable interpretation, the way that the tax court looked at the regulation to say that you bifurcate the transaction to two separate transactions and determine both, first, the 751A amount of ordinary income, and then two, the 741 capital gain piece. So the D.C. Circuit did not say that the IRS's position was wrong, but said that there were two different ways to look at the regulation. And I know that the way that the FTB is looking at the regulation, the way that the FTB has cited the regulation in their legal ruling, stands for the proposition that there are two separate transactions, and they're using that as support for their position that there is a distributive share when the partnership is deemed to sell the partnership property, and any 751 portion of that which is allocated to the selling partner would then be treated as ordinary income, and it would go beyond just character, but it would be then look to the sourcing provisions. Obviously, in Rawat, we're talking about international sourcing provisions. Here, we're talking about 17951 and 17952, as you said. So the sum of my question is this. Specifically looking at that regulation, what is your specific argument as to why that regulation doesn't do what the FTB claims that it does and what the IRS argued that it did in Rawat? And I could clarify the position more if you'd like, but I think you understand.
Yeah, and you can put it on the screen if you wanted. But so that regulation says, again, we as we went through in the presentation, 751A, there's three, A, B, and C regs, and then there's the 751B regs. The -1A2 reg says the income or loss realized by a partner, again, it's the gain of the partner, is the amount of income or loss from Section 751 property that would have been allocated to the partner to the extent attributable to the interest sold if the partnership had sold all of its property in a fully taxable transaction for cash immediately prior to the partner's transfer of the interest in the partnership. And that gains ordinary, the rest is capital, okay? So, I mean, very specifically, just looking at this in isolation, this is telling you that you don't have income allocated to the partner because it's as if it would have been allocated to the partner, but it's not, because there is no income to allocate to the partner. I don't think anybody would say otherwise, that there actually is income to allocate to the partner, and there's no income from a deemed sale to allocate to the partner. It's income that would have been allocated if the partnership had sold all of its property, knowing that the partnership didn't sell anything and wasn't deemed to sell anything. So just looking at this regulation, it's enough to see that the plain language doesn't create a sale of property by the partnership, a deemed sale of partnership property, a distributive share of income that flows to the partner. It's just recharacterizing the character, as we would say, from ordinary to capital. But you can't look at the regulation like in a vacuum. Like the regulations, and the statute, and 751B, and those regulations, and the 702 regulations all work together. I mean, the sub K regulations are thousands of pages, but in 704 allocation regs, like they all work together. And the whole framework of sub K is I've got partnership level income, distributive share income, and when I have distributive share income, I have provisions in the code that tell me how to specifically, separately state or not separately state those items, what the partnership needs to do with respect to all these different types of income, and then put it on a K1 for reporting purposes. And then I take it into account as a partner. And I'm told that because there's a specific rule that tells me to do that. We all know from experience that when you sell a partnership interest, that's my transaction. That's the partner's transaction, my gain or loss. And this is just telling me to treat some of it as ordinary. If I compare this language to the 751B regs or the statutes like we looked at, once you get to the point of, not in a vacuum, I can read this and I already know what it says, but if I look at this in connection with everything else, now it's really clear to me that I have no distributive share income. And so that's my answer. And again, please come at this, or I would ask everybody to look at this from the standpoint of what is the law? What is the law? What has it been? What body of law is out there? Cases, statutes, FTB guidance, rulings, TAMs, manuals, administrative decisions, articles. There is no question that in 2012 or 2013, and probably not until 2022, as far as I know, with this ruling, that there was ever a consideration, at least, I've never seen one asserted in a case until the audit of this one, that 751 ordinary income under California law would be distributive share income to be sourced under this reg. That's the bigger picture here. So, yes, I get it. I want to debate like what this reg says and what the tax court says, but there is a huge thing going on here, which is that this ruling changes the law completely, and that applies to everybody on a daily basis. I see it in my practice. It is that big. We could not have filed a return that way. I would say if I look at this regulation in 751-1A2, I could not have looked at that regulation and said, oh, I have a distributive share of income. I could not have gone to Tory Burch LLC and said, hey, I've got a distributive share of income to source. Like, it doesn't say that. Tory Burch would tell me, no, you don't. This wasn't a distribution. I have to give you a piece of paper that tells you what your computation is. Like, that's how that works, right? So, I'm probably rambling at this point, but I think I look at that regulation, and I think it's clear as day that it's just operating on my income or loss and telling me the amount that is treated as ordinary income is the amount that would have been allocated to me, had there been a sale. And by the way, again, for state law purposes, well, federal too, when the partnership does sell that property, it is going to generate distributive share income to the partners. So, like, the FTB doesn't get to tax it twice just because a non-resident is selling an interest and maybe not in the state anymore. That distributive share income, when that inventory is sold, is going to be taxed to the partners who were partners at the time it's realized, right? So, hope that answers it.
It did.
And more.
And more. I appreciate it. Thank you. No further questions.
I have questions, but I'm going to wait. I want FTB, who's been waiting patiently, to get their time to present. So whenever you're ready, you have 45 minutes.
Thank you, Judge Gast, and thank you to the panel, and thank you so much to Appellant's Counsel. As I mentioned, I represent respondent along with Leah Thyberg, and what I'm hearing so much from the appellants is frustration. And I think I appreciate it because I think that what's really challenging, and full disclosure, I'm a nerd. What I really like about this case is that it requires somehow the weaving of these seemingly inconsistent areas of law. And that's what's challenging. Can it feel frustrating sometimes? Can it feel, where's the clear answer? Where's the right answer? Is it written someplace? I appreciate that. I think those are the same exact questions that we're coming to you with as well. And we're coming in, and there's the conversations that we certainly have when it comes to coming up with positions and it comes to trying to understand the reconciliation. It's not, hi, I'm a sourcing subject matter expert, take my word for it. It's like, okay, let me hear your perspective from partnership law. And as we know, subchapter K is its own precise area of law that is really involved. And in subchapter K, you're not really asked as much to make some of the leaps that we see in Appeal of Smith, in the sourcing law that showed up in Appeal of Smith, that show up in the appeal of, Valentino versus Franchise Tax Board, and to some degree in J.P. Morgan versus Franchise Tax Board, because that's what happens with the state sourcing. So fundamentally, we have this issue of, if you look through a lens of subchapter K and you look to state sourcing, you're not going to get the full picture. If you look through sourcing and you don't acknowledge subchapter K, you're not going to get the full picture either. So we have to come through this in a methodical way. And I think one of the other things that's interesting is there isn't a great deal of other states grappling with the same things, because I think part of that is we have states that don't have income tax. They don't have income tax at all, We have other states, such as Massachusetts, that has a much broader standard. They're much more like the federal standard, and we see that in Appeal of Buehler, where they have this essentially like effectively connected income. And California is unusual and has a position that's really quite favorable to non-residents by saying, you know what, it might be effectively connected, but we're going to say this is an intangible, and we're going to send that back to your state of residence. So what we're really seeing here, we're seeing a couple things. We're seeing this historic tension that has always been in the sourcing law, which is which state, where are you doing business, and can we know that you have some business operations? You're generating income in the state in which you are not a resident to make it California source income? Or should this be an intangible, something that is really better suited to you personally, following you with the mobility rule back to your state of residence, except for the exception of with a situs? So that's the tension we see in this case. And so what is interesting is we really don't, the relationship between 2202 and the assessment in this case are not as intimately intertwined. Respectfully, we see it a little bit differently, because if the panel found certain language within the legal ruling they disagreed with, it's possible to uphold this assessment and to say, we're disregarding some of this language. That's exactly what happened in the Appeal of Smith and Legal Ruling 2201-01 when it came to discussing the issues of control. And I think that's in one of the footnotes in the Appeal of Smith. It sort of talks about that, and you see this kind of difference, because that's a publicly stated position. That is not what's ultimately at issue in this case. What's ultimately at issue in this case is this tax assessment proper or not? But one of the other things that Smith shows us, and just to point out that this issue does make an appearance in Appeal of Smith, and if you look to, I think it's footnote 14, talks specifically about how Franchise Tax Board in Appeal of Smith, which is now a 2023 decision, had, and it was also a 2012 case, that it had raised the exact argument as to whether the gain generates business income and is apportioned at Shell's level under IRC Section 751, even in the absence of a unitary relationship. And the panel went on to say it did not need to address this issue. It declined to address this issue because it was sustaining the unitary position in that case. So this issue has appeared publicly before, as seen in this footnote. But more importantly, in this case, the facts are not in dispute, which is unusual. This is a case about Mr. Burch held a 98% membership interest in JCB Investments. JCB held an investment in Tory Burch, LLC, the well-known fashion brand. The eponymous designer and executive Tory Burch was formerly married to Mr. Burch and he sold most of his 28% share in his former wife's brand for $650 million in late 2012. And as has been mentioned, Tory Burch LLC operates brick-and-mortar retail stores and engages in online sales for clothing, accessories, and lifestyle items, including fragrances. It possesses assets of tangible goods and unrealized account receivables related to those goods, and it operates within and without California. The apportioned income to California was approximately 13% and 16% respectively for the tax years 2012 and 2013 that are at issue here. And that's interesting as well. It brings up another point with the emphasis on 51-4D, that is for unitary partnerships. That this is a unitary entity. If the entity were not unitary, we would be looking at it potentially under a different provision, such as 17951B, which talks about the net income. But the question here is whether the determination regarding the source income is proper under federal and state law. And the answer to that question is clear. Yes, the sourcing is correct. And appellants carry the burden to prove that the tax assessment is erroneous. And the tax assessment is based on the APES 2 that was issued by the auditor in 2017. So what is really at play here? We do have these two bodies of law, but the case ultimately involves two competing theories of the entity and the aggregate theories of partnership. And there's a conflict between these two theories. And with conflict comes tension. And that tension is what's playing out in subchapter K, and it also plays out in the sourcing of the income in this case. So how do these two competing theories interact? We have a dynamic between them that, bear with me, operates a little like a sibling rivalry. We have one code section that would have you believe it's an only child. That's 741. It treats a sale or exchange of partnership interest as one thing, the sale of a capital asset. This is the entity theory in action. And here's the exact language where we track this entity theory, taken from 741. In the case of a sale or exchange of an interest in partnership, gain or loss shall be recognized to the transferor partner. Such gain or loss shall be considered as gain or loss from the sale or exchange of a capital asset. Now that sounds like an inviolate rule. The sale of a partnership interest is treated as a capital asset, but that's not all the language of 741. And so there's this limit to this seemingly inviolate law that starts with a comma. That language says, comma, except as otherwise provided in 751, relating to unrealized receivables and inventory items. So here's the aggregate theory stepping onto the stage with 751. And 751 says, actually, let's treat the selling partner as if they sold an undivided interest in each and every partnership asset to the buyer. In practical reality, this aggregate theory functions as a carve-out from 741. So 751 says, like any second sibling, you need to share this stage with me. You don't get the final say, 741. There's two of us, 741 and 751, and we operate like a family. We're siblings with a different point of view, and we need to be considered, even when this viewpoint creates tension. And both of these siblings, these theories of entity and aggregate, are represented on Form 8308, where the income is captured in black and white. And the partnership includes the amount of income attributable to 751A property. So what exactly is 751A property? And I apologize, this is going to get a little dry. Section 751 property is unrealized receivables and inventory items. An unrealized receivable is an account receivable of a partnership which has not yet been included in income. And there's 3 categories of unrealized receivables: goods, services, and recapture item. And Section 751 defines the term unrealized receivables to include, to the extent not previously includable in income under the method of accounting used by the partnership, any rights, contractual or otherwise, to payment for 1, goods delivered or to be delivered, to the extent the proceeds therefrom would be treated as amounts received from the sale or exchange of property other than a capital asset, or 2, services rendered or to be rendered. So unrealized receivables also includes a list of partnership assets which, if sold by the partnership, may result in ordinary income recapture. The most common unrealized receivable recapture item is partnership property subject to depreciation recapture under Section 1245. So the operations and the implications of this. The operation of our 2 sections, our 2 siblings, 751 and 741, treats the sale as 2 distinct transactions. One in which the intangible partnership interest is sold by the partner, and one in which the underlying Section 751 property is treated as sold by the partnership immediately before the partner disposes of its interests. And the classification of the 741 and 751 property has implications. The 741 gain is treated as capital gain and taxed at a more favorable federal rate. The 751 gain is taxed at a less favorable ordinary income tax rate to reflect the fact that it's operational income. But those aren't the only consequences. There are consequences, for example, that the PricewaterhouseCoopers partner experienced an appeal of Mingo. This is the Fifth Circuit Court of Appeal decision where the court found that the partner was not eligible to use installment sale treatment for the gain when the commissioner determined a portion of the gain reflected 751 property and needed to be recalculated as ordinary income and not capital gain. The court held that because the gain from the unrealized receivables was required to be reported as ordinary income, the installment method could not be used. So they're barred from using the installment method because of this. And there's state consequences in California. So California is treating 741 and 751 gain as 2 separate sales in appeal of Bentz. And they found that the Board of Equalization found that the sale of appellant's partnership interest should have been fragmented and treated as, first, the sale of an interest in the partnership's unrealized receivables, and second, a sale of the remainder of the partnership interest. And while I appreciate that this was a residence case, it was the application of 751 that we pull from that. It's the application of 751 and 741 that's pertinent to this case. And it wouldn't be, sourcing law does draw from residency law at times, and we see that with appeal of Bueller, we see that with these appeal of Christman, because it's the interpretation of sourcing, it's the interpretation of the rules that are applied both to the resident and the non-resident when we're dealing with sourcing and we're dealing with OSTC. And applying Bensi in this case is completely appropriate for that exact same groundwork. So with 2 separate sales, we have 2 separate sourcing analyses. The capital asset sale of 741 is treated as an intangible and sourced to the state of domicile under 17952. And in comes the 751 sale, which is treated as income from a business, trade, or profession and sourced under 17951-4. And interestingly, we see this treatment foreshadowed in Appeal of Ames, which is obviously a case we cite too when we're talking about what is an intangible. But as they walk through the law and the legal statement in there, they cite to one case, and they say these appeals are concerned with the gain realized by limited partners through the sale of their ownership interest in partnerships. The gain was not the result of partnership operations, but as the result of a sale of intangible. And when you look to that language, you can see that in a way, the Ames Court is leaving open, it is possible that some of this gain could be gain from operational income. IRC Section 702B explains how to characterize items that would constitute a distributive share of partnership income. The character of an item of income or loss included in a partner's distributive share shall be determined as if such item were realized directly from the source from which realized by the partnership, or incurred in the same manner incurred by the partnership. And that's how we made the leap to characterize 751 to the regulation in 17951-4. This also foreshadows the appeal of Smith. And as to the appellant's objections, this takes us right to the heart of their objections to the sourcing of the gain. Their argument hinges on the idea that all of the gain has to be unseverable intangible income. And they seek to portray 17952 as this monolith and essentially claim that all income received in tandem with the sale of a partnership interest has to be given this treatment. It's almost the reverse of effectively connected income. It's all saying it's like effectively intangible income. And that's not supported by statute or precedent either, nor is it supported by subchapter K, because essentially what that does is it requires you to treat 741 as an only child and say 741 is exactly how this should be sourced in California. And this is ignoring the role that 751 is playing in the sale of partnership gain. And it also ignores 702 to look to the income producing activity and set the character and have it flow through. And this is akin to the leap that was made in the appeal of Smith, where the unitary relationship created business income. So looking for perfect symmetry between the calculation rules in the Treasury regulations and 17951-4, it's a red herring, all due respect. And it's a red herring because the Court of Appeal told us in Valentino versus FTB that the California legislation action, the action of the California legislature, I'm going to move on from that sentence, is the primary consideration. And here, the California legislature conformed to 741 and 751, which that obviously made it law in California. And then we have the Board of Equalization ruling in Appeal of Bensi that directs us to use this dual sale treatment. And two sales involves two separate sourcing analyses, an intangible and income from a business, trade, or profession. And that tension is the tension we've seen in the California Code since its inception at the early part of the 20th century. And appellants have introduced the new exhibit, Exhibit 5, into evidence in the pre-hearing conference. And this article discusses the D.C. Circuit case. With the introduction of this new exhibit, they're refocusing their attention onto the deemed sale of inventory approach. That was central to the D.C. decision in Ruwat. And they find that that the question was whether 751A created a deemed sale of inventory, because if there was a deemed sale of inventory, then there would be U.S. source income. But due to dependency on the federal sourcing rules, the stated issue and analysis focused on whether IRC Section 751A deems inventory sale as income from the sale of the inventory itself. That's not the issue here. For California, the question is not whether IRC Section 751 provides for a deemed sale of the 751 property. Instead, for California, the question is whether the appellant's gain that's attributable to the partnership's 751 property is the result of partnership operations sourced under 17951-4, or from an intangible, going to 17952. And this exhibit really places unnecessary weight on the deemed sale approach. If the panel agrees with the article and the D.C. Circuit's rejection of the deemed sale approach, that conclusion still does not need to does not impact the result of this case. So here, their focus on, the DC Circuit's focus on IRC Section 751 language is instructive. Respondent is not trying to force language into 751. IRC Section 751A explicitly provides that the amount received by a transfer partner in exchange for all or a part of the interest in the partnership that's attributable to unrealized receivables of the partnership or inventory items of the partnership. Sourcing law provides that answer in Section 17951-4. That regulation specifically sources income from a business, trade, or profession. Income from partnership operations are income from a business, trade, or profession. And how do we make that leap? Well, we make it in two ways. First, we look to this legislative action when using the regulation. That's what Valentino versus Franchise Tax Board tells us. In that case, the Court of Appeal held that the California legislature intended to look directly at the source of the income, not the situs of the stock in that case, to determine whether the non-resident shareholders' pro rata share of the income is taxable by California. The court then found that given the hybrid entity approach of both S corporations and partnership, sourcing a pro rata share of a unitary S corporation could be read into 17951-4D, when the regulation at that time didn't actually have a specific provision for sourcing a pro rata share of income from a unitary S corporation to a shareholder. The regulation was subsequently amended. This flexibility in sourcing law present in Valentino demonstrates that looking to legislative effect, carving out 751 as operational income from the capital asset of 741 is appropriate. Next, it's appropriate to look to the nature of the entity. And in this case, it's the partnership that has competing theories of aggregate and entity, as outlined a moment ago. And finally, appeal of aims itself suggests that operational income is separate from the intangible partnership interest. When the Board of Equalization wrote, the gain was not a result of partnership operations, but the sale of an intangible. So these are the steps that walk through to get us to the reporting under 17951-4. And a moment on the reporting question, respectfully, Schedule CA, which is filed with the 540 NR for non-residents and part-year residents, has the 3 columns listed on there where they have their AGI on one column, the federal AGI, and then they go into the amount that would be taxed to a California resident and the amount of source. And the column that permits the reporting of income where you would put business income, that is where the 751 gain could be reported, and then the intangible portion of the income would be reported as non-California source income. To the extent that it could be made clearer and more user-friendly, we would certainly be open to those comments. I think those are valid, and that would certainly we would certainly be able to follow up with something along those lines. But the current reporting is permitted under the Schedule CA. Because the language explicitly provides that the partner's 751 gain is the amount attributable to the partnership's 751 property, which is calculated under the Treasury regulations, as the amount attributable to the partnership's 751 property that would be allocated to the partner if the partnership sold all of its property at fair market value. IRC Section 751A itself says that this gain is what is attributable to partnership operations. The amount realized for this 751 gain is generally calculated under Treasury Regulation 1.751-1A2 as the amount of income from the partnership's 751 property that would have been allocated to the partner if the partnership sold all of its property at fair market value. This specific Treasury regulation language, if the partnership had sold all of its property, is how we know that 751, again, relates to partnership operations. If the partnership treated as selling all of its property in calculating the income realized by the partner, then that income is from partnership operations. Additionally, the regulation specifies that it's the amount of income from the partnership 751 property that would have been allocated to the partner if the partnership had sold all of its property. And the use in the Treasury regulation of the word allocated shows the 751 gain is the partner's share of partnership income from the partnership to the partner, which again is sourced appropriately under 17951-4D. But regardless of whether there's a deemed sale of the 751 property itself, this gain, 751 gain, is from partnership operations, treated as though allocated to the partner, and therefore the income is sourced for California income tax purposes under Regulation 17951-4D, more appropriately than under 17952. Now I'm going to turn it over for some more partnership-specific answers from Ms. Thyberg.
Thank you. I'm on rebuttal duty. So I have 2 points. I would first like to address appellant's arguments on the preferential tax rates and carve-out. It is correct to say there is no preferential tax rate in California. So what's the point for us? Well, California still conforms to IRC Section 741 and IRC Section 751A, pursuant to RTC Section 17851. IRC Section 741 creates a carve-out for IRC Section 751. This carve-out is even described in Indu Rawat. You can see this carve-out in the Treasury regulation for 741. Treasury regulation 1.741-1A is really where you see the peel away. It says, the amount realized shall be reduced by the amount attributable under Section 751 to unrealized receivables and substantially appreciated inventory items, and the adjusted basis of the transferor partner's interest in the partnership shall be reduced by the portion of such basis attributable to such unrealized receivables and substantially appreciated inventory items. This is 2 separate sales. And therefore, we are looking at 2 separate gains. IRC Section 741 gain and IRC Section 751 gain. My next point. Next, I'd like to address appellant's argument on the deemed sale approach to generate distributive share income. The appellant's entire argument today is focused on whether IRC Section 751A creates a deemed sale of property. They argue that the 751 gain is not properly sourced to California because there is no deemed sale of 751 property generating distributive share of income. They point to Indu Rawat as support for this. The D.C. Circuit in Indu Rawat analyzed whether IRC Section 751A created a deemed sale of the inventory itself, because if there was a deemed sale of the actual inventory, then there would be U.S. source income. The focus was on whether IRC Section 751A created a sale of the inventory itself for purposes of applying federal sourcing rules. This is not the issue here. For California, the question is not whether 751A provides for a deemed sale of the partnership 751 property. Instead, for California, the question is whether appellants gain from the sale of their partnership interest that is attributable to the partnership's 751 property is the result of partnership operations or from an intangible. Even if there is no deemed sale generating income, the 751A gain itself as a separate sale, separate gain, includes the amount realized attributable to the partnership's 751 property that would have been allocated to the partner if the partnership sold all of its property. The explicit language of IRC Section 751 and the Treasury regulation shows how the 751A gain is from partnership operations and therefore properly sourced under CCR Section 17951-4D. Thank you.
Does that conclude your presentation?
Yes, thank you, Judge.
Okay, thank you. At this point, I'm going to turn to my co-panelists for some questions. Judge Lee?
Thank you for your presentation. I don't have any questions.
Okay, and Judge Farmilario?
Yes, thank you for your great presentation. I'd like to start by flipping the question that I had for appellants and to ask you, specifically the statutory interpretation that the D.C. Circuit took in Rawat, and the way that it analyzed the language in 751A was that it almost mirrors the language in Section 64 that defines ordinary income. And as a result, it held that the statutory language itself is clear on its face that 741 and 751 together deal with the characterization of income as either ordinary or capital, but it does not make a leap, to use a word that you used a few times, to then allow the commissioner in Rawat to argue that there was a deemed sale of inventory, and as a result, then you could look at the international sourcing provision that held that if it was inventory, it was effectively connected income at that time. So again, the question I have for you is your position on the D.C. Circuit's statutory interpretation of the language in 751A.
Yes, I got that. So, Indu Rawat is really interesting to me. I appreciated the analysis walking through how important IRC Section 751A language is. And they really balanced what the IRS was arguing, which was that it created an actual sale. And especially, I really like the point of looking at whether we can add language to 751 itself. Is it a sale of the inventory itself? That was what that balance was. Well, the question they were grappling with was to try and answer a federal sourcing question, because if that was a sale of inventory itself, then it would be U.S. source income. So it's really difficult for us to look at that analysis and say the same applies, but I appreciate the focus on IRC Section 751 for purposes of applying California sourcing rules. And the language itself in IRC Section 751A provides that this portion of the partner's gain, so related to 751, is the interest in the partnership attributable to unrealized receivables of the partnership or inventory items of the partnership. We don't even have to read language into 751 for our California sourcing rules. To us, that is clearly partnership operational income. And what is even more helpful is the Treasury regulation, which I know you already know it, but it's very helpful because it talks about, well, how do you calculate that amount realized? The amount realized is calculated as the amount so the interest in the Section 751 property is the amount of income or loss from Section 751 property. Again, this is all at the partnership level that would have been allocated to the partner if the partnership had sold all of its property in a fully taxable transaction for cash in an amount equal to the fair market value. And then more language. But it is really interesting to me because we can use Indu Rawat as instructions for, 751 is important. The language is important, and especially for California sourcing rules.
Okay, thank you. No further questions at this time. Thank you.
I want to give the taxpayer 30 minutes. I don't want to run out of time, so afterwards we'll do more questions. So, appellants, you'll have 30 minutes for your closing statement.
Okay, thank you. I just want to make some comments or responses to the presentation. And let me just come back to you, Judge Famalaro, because I had a chance to go back and then look at the tax court case because I hadn't, and it comes up in your second question. I think looking at the tax courts, when you asked me the question and we're looking at the language shall be considered as amount realized from the sale or exchange of property other than a capital asset, and property could be more broad than assets, et cetera. And it makes sense. I understand that, especially in the context of the federal sourcing rule they were looking at, which is, hey, they're just trying to find something that is income derived from inventory property. It's very different than here. What the issue is in our case, and why I think it's stronger in the analysis, even stronger for us, this language in 751A that we were talking about, it doesn't create a distributive share of income. Whether it's considered as income attributable to inventory, and there's way too much, attributable doesn't mean, attributable means attributable, it doesn't mean distributive share. The very simple problem here is that the FTB's position requires the existence of a distributive share of income, because that is what Section 17951-4D applies to. And I don't think we were listening. I don't think we heard the word distributive share come out of that side of the table in the last 30 minutes. I don't think it was mentioned. I don't know if I'm in therapy or if I'm in class or something about the siblings, but I'm telling you that what we have here, we need a clear rule of law, and there always has been a clear rule of law to source income from sales of partnership interests. It's not that hard. If we put it back up on the screen, 17951-4D is the provision the FTB is saying applies here. It's okay. So what I would ask the FTB is it their contention that since 751A has been in the code, that it is under California law, the selling partner's ordinary income is and always has been treated as a distributive share of the partnership's business income that's sourced under 17951-4? The answer is no. If it were, certainly they'd have authority, to explain that. Certainly, but they don't, right? We know that. And again, Bentz is not authority for any of this. Bentz just shows that FTB and the state board know what 751 is and does. And there's been no mention ever that it's, the fact that you have an amount attributable to the partnership's, ordinary income property is all of a sudden a distributive share of, the partnership's ordinary income. It's not. And that's just important because, they're using the word attributable to make it sound like, or that this is income from operations. There's no dispute that income from partnership operations, just like corporate income, that is business income, subject to UDIPA, sourced, in a portion to the states. And I mean, we have to live by these rules every day. And this is how, we all know how these rules work. You can't take the selling partner's ordinary income under that statute and magically turn it into a distributive share of actual operating income from the partnership. And again, now the FTB is getting double tax because the FTB is going to get the tax on the business income when the business income is realized and reported by the partnership and flows through. Telling the selling partner that they actually have a distributive share of that business income when it doesn't exist is like, now they're getting it from the selling partner and they're going to get it from the partner who buys it at the end of the year, right? I mean, that's just a fact. So all of this stuff is irreconcilable with, the way the rules actually work and the language. A couple other points. We don't need to sit here on behalf of appellants and say that you need to invalidate the ruling, by the way. We just know that the determination in our case is wrong. I think the ruling is invalid for a million reasons, but we just know that the determination of appellant's case is wrong as a matter of law. It's based on the ruling, but the legal reasons for the determination are just wrong, right? So our position is simply, please withdraw the FTB's determination there. Did I answer your question about the tax court decision?
You did.
Okay, thank you. Okay, another. Have a sip of your water. I ran out. Another small point. The concept, this discussion that's in the briefs a lot, that an intangible property or 17952 is a monolith, whatever that means. Here's the reality. 17952 sources income from intangible property. Covers lots of stuff. Royalties, all sorts of types of payments, and sales, stocks, bonds, and capital gains from sales of partnership interests, and all of the gain income from a sale of a partnership interest. The exception is written right in the rule for 17952. If it's sourced to your state of domicile unless it has a business situs elsewhere. Case you mentioned, Christensen, that's a business situs case. Metropolis, Judge Gass wrote about business situs of Goodwill, right? If there is an exception to taxation to income from an intangible, it's governed by the business situs rule. I've heard a lot of obfuscation. There's nothing to debate here in the academic world at this point about whether there is, 752 is not sufficient to, source this, or that there's some other sale. We're not reading into the law a separate sale. We know that we need to treat a portion of the selling partner's gain as ordinary income. And, that concept I keep hearing is being used it's a separate sale. Okay, fine. It's a separate sale. It's a calculation. But that sale explicitly, whatever it is, calculation or not, it's not generating a distributive share of partnership income. And you got to have a distributive share of partnership income for this case, to hold water if you're the FTB. And again, I'll just come back to the final point. And by the way, Ames doesn't leave anything open, because Ames, in those cases, they're all about business situs. Hey, no, selling partner who's a non-resident, your gain is not California source income. FTB, you're conflating the concept of, business operations in the state, because the partnership's doing business here, with the income of the selling partner who lives outside of California and is selling it and realizing income. If there's a business situs, though, then you'd have some California source income, but you don't in Ames, right? We're not talking about the business situs rule in our case. We're talking about, do we have an actual distributive share of income that the Franchise Tax Board's regulation itself, the plain language of its regulation, applies to? We do not, and they cannot sit there with a straight face and tell me that we do. And they haven't said that they do, and they certainly can't say that the law prior to legal ruling 2022-02 provided for that, because it doesn't. Anything else? us come back to, we'll be done. I love that we're frustrated. Apparently, we need to go to therapy. We should come here more often. Again, what taxpayers, what are the appellants in this case, and all taxpayers rely on is clear rules, like rule of law, especially for common everyday transactions. I don't know how many hundreds of thousands of partnerships exist in this world that are taxable here, but just, as my firm probably prepares 2 million partnership tax returns a quarter, right? And there are people selling partnership interests every day, and the rules work. Like, they're in plain sight. I can go look at the 741, 751, 702 rules and the tax returns, and it all works perfectly. I can come look at the California returns, and it all works perfectly. This is the first time now in the history of this issue that it's now come to light. Like, hey, we've got this ruling. It's very obvious that the FTB started looking at this issue after 2012 and 2013 tax years, because as we saw in Smith, it was raised there. As we saw in this case, it's raised there. And we know, again, from the audit file here, that there was a lot of discussion going on where even in the correspondence, I'm being told, or the appellant's representatives, meaning me, are being told that, oh, they're looking at this and there's a task force and everything. So all that's to say that this is not the law that is being claimed to exist and that's so clear and, no, this is a position that was developed. And if it's a position that's developed, then the proper avenue for that is to put it out in the public eye, get comments, go to the legislature and figure it out. Because again, there's a lot of repercussions to this that aren't even dealt with, like on the corporate tax side. Again, the whole concept of taxing the selling partner, but then what do you do about the income that's going to be realized attributable to that, which now the new partner has? Is it like a reverse 754 election? I don't know, but there's a million, things that would have to be dealt with. That's all just too complicated, and it's way too much weight to put on the word attributable and say that all of a sudden, because it's attributable to, my interest in the partnership's property and considered as an amount realized from the sale or exchange of property other than a capital asset, that all of a sudden that means that I actually have a distributive share of income to source under the regulation that they say applies. We don't have that. Again, happy to have a public discussion and consider sourcing 751A ordinary income. I think that's certainly something that could be thought about. Again, guaranteed payments by legislation are sourced as distributive share income, not as comp or money for like interest, right? They have a special statute that does that. You could do that here if the legislature wanted to enact that. We don't have that law now. I think. Anything else, Evan? Any other questions for us?
Well, if that concludes your closing.
I think we're done.
Okay. So I'll ask the panel one more time for questions. I know Judge Formulario, sorry I cut you off there, but do you want to continue with some of the questions you have? We have about 30 minutes left in this hearing, so.
So my question for FTB, the way I understood your presentation was that even if the D.C. Circuit in Rawat was correct, it doesn't alter the outcome in this case. And I just wanted to clarify one thing to make sure that I understood it. The way I understand this D.C. Circuit's opinion, so the D.C. Circuit, the tax court, and the IRS, they all took the position that 741, 751, it characterizes income. It's not a sourcing provision. And then the IRS took the position that it does something more than that there's this deemed sale of inventory, which was what was at issue in Rawat. And the D.C. Circuit, first the tax court agreed with the IRS, and the D.C. Circuit came back and said, no, we don't think that that's what the statutory language provides. And your reading of the regulation to support that position could be read one of two ways. And we're reading it as a calculation of the amount of ordinary income and the amount of capital gain. So the way that I see the Rawat opinion is that it deals with the characterization first of income, and then in the DC Circuit, it says we don't go beyond that. We are not saying that there's a deemed sale. And so in Rawat, we're looking at the international sourcing provisions. In this case, we're looking at the California sourcing provisions. I see parallels because in that Rawat case before TCJA, there was no specific sourcing provision for the sale of a partnership interest similar to California. So we have 17951, but it's not specific. It deals with, as you both have said, intangible personal property. So I understood your position to be that the DC Circuit opinion could stand alone and stand as correct, and you would still have the authority for the position that you're taking that there's a deemed sale of the second transaction, this deemed sale of inventory and or collection of accounts receivable. And I just wanted to give you an opportunity to clarify that position, and it would be helpful to me if I could understand your position a little more fully.
I want to start first from, thank you, Judge. I wanted to start first from what was different in Rawat. And those sourcing rules that had a different requirement for finding an inventory sale. We don't have that exact requirement in California. And that's one reason where it's not the same question. That's an extremely narrow lens to be looking through. I think that we brought up the case initially to show this question of bifurcation. And we also, and because I had alerts on that case, the moment that the DC Circuit decision came in, which I think was a bit of a surprise, when that came in, immediately filed it and brought it to your attention for just that reason, to say, hey, this new case came out. And what we briefed at the time is our position as a tax agency is, that wasn't the proper reasoning. But going one step further, I think, especially because that was a very quick briefing clock, we do think that fundamentally you can still go back to that language, that it isn't. I appreciate the question is kind of getting into, didn't they discard that reasoning? And we still think you can go back in to find the language for purposes of California sourcing rule. And I'm going to have Ms. Liebert talk about that.
Yeah, so I'd love to just clarify 751, how we've been looking at 751 today, especially because appellants are focusing on that deemed sale of property. And as you've raised, in Indu Rawat, the whole focus also was on whether there was a deemed sale of inventory. And that was so important that they did end up creating IRC section 864C8 to have that deemed sale of inventory. But here, again, in California, that's not our question. We are looking at whether this is from partnership operations or from an intangible. And to tease out what we are saying, even if there is no deemed sale generating distributive share income in that way that has been argued by appellants, the 751A gain all by itself, that's a whole separate gain that we need to look at sourcing. How do we source this? Well, this gain includes the amount realized attributable to the partnership's 751 property, and we get to see how it's calculated. It's calculated as the amount that would have been allocated. Allocated feels kind of important, doesn't it? Allocated to the partner if the partnership sold all of its property. The explicit language of 751A and the Treasury regulations show how really this gain is all coming from partnership operations. And so it was correctly sourced under CCR section 17951-4D. I hope that helps clarify.
It did, and I appreciate it. Thank
Okay.
you.
Okay, I have a few questions for appellants, but it's really more towards facts because I'm a little confused on some of the facts, just for my own background. So Tory Burch, there were a few sales by JCB. It wasn't just one. There was a few, 2012 and 2013. Is that correct?
Yeah, but yes. Do you want me to go through the background for you, or just?
No, that's fine.
Yes.
I've
So
read
there
all
were
the
sales in 2012 and a sale in 2013.
Okay. And then the NOL we're talking about for Appellant Burch is the 2013 NOL. So there was additional income attributable to Appellant through 751A for 2013. So that reduced his NOL, and then it reduced the carryback.
Those are all. Sorry. Go ahead.
Oh, go ahead.
No, they're all secondary adjustments based on the primary adjustment of.
No, yeah, I understand. Just as I
Yep.
understand the background for what was adjusted. So it was a 2013 NOL, no other NOL.
Not that I'm aware of.
Okay. And we're also dealing with, in 751A1, unrealized receivables and inventory items, not just inventory items. Is that correct?
Yeah, the amount of.
Okay.
Yeah.
Okay,
Tory
I
Burch
just
is-
wanted
yes,
the
yes,
background
yes,
there.
yes.
That's it for my questions. Everything was well briefed. It's laid out there. So, Judge Lee, did you have any final questions?
Just one. Appellant makes the argument that FTB position results in double taxation. I was wondering if you can address that point.
Yeah, I had questions about that question too. Can I ask them? I don't see how that is double taxation. I mean, the income, when the interest is sold, the partner is going to be, I mean, there's a potential for double taxation for a non-resident between two states. But there's, I mean, for instance, if the non-resident lived in Massachusetts, they're going to be they're going to be taxed on. Actually, let me change my hypothetical. If they're living in New Hampshire, which doesn't have a state sales tax, and the business also apportions, because they're at pretty minimal apportionment percentages, 12 and 16%. So you imagine that this company is doing, this unitary partnership is doing business throughout the country. So there are going to be instances of double taxation potentially. When you have, if Tory Burch LLC is doing business in Massachusetts, which would be highly likely given the Boston market, I would expect that they would potentially have 10% of income. That state would tax potentially 13% of the whole gain.
If I can interject.
Oh, sure.
Maybe perhaps, appellant, can you restate your position on that double taxation point, and then you can possibly
Sure.
respond
Sure,
to that.
sure.
Thank you.
Yes, and this is why it's super important to have a very solid understanding of sub-K rules. This says nothing about state tax. The FTB's position is that the selling partner's amount of ordinary income is distributive share income and taxed as a share of the partnership's business income. So under this new rule, selling partner would have my gain from my sale of my interest measured by my, amount realized on an adjusted basis. And I would normally pay tax on all that to my state of residence, let's say, absent a business situs. Now, because of this California rule, I'm going to treat the 751 piece as business income and pay some tax to California based on, the apportionment percentage. Okay, so now California is taxing based on the theory of I've got business income to tax. Okay, well, what is that ordinary income, business income attributable to? It's attributable to the partnership's income, but the partnership is going to realize that income when it collects on the inventory and the receivables in the future. So I'm telling the selling partner today, hey, you got to pay tax on California source income because the partnership itself has, some property that is going to generate some California source income going forward. So we're going to take some of that from you right now on your gain. And meanwhile, the partnership's there all along, selling inventory and collecting on receivables, and all of that income at the end of the year is going to get allocated to the partners at the end of the year, and they're going to pay tax on that income. So if my selling partner has a 1% interest in the partnership, and I'm going to treat some of that gain for California purposes as a share of like business income that hasn't yet been generated, but then like it is going to get generated and taxed to the other partners, that's where the double tax comes in. And by the way, this is all these issues exist outside of this, like in the federal side. That's why there are super detailed rules that on the 751B side make adjustments. Like we're going to allocate the income to the partners other than the distributee partner. Okay? We don't do any of that on the 751A side because there is no partnership income. If there were, you'd have to make all sorts of adjustments at the partnership level and have provisions to exactly explain how this gets divided up among the partners when you make a change like that for one partner. Okay, so the double tax is simply the operating income going forward. I'm saying California's going to get that. You don't need to tax the selling partner now as if that were, because they're going to get it. And let me just, my last point, because I did want to make a comment to their comment. It all comes down to, in their argument, that this is income from partnership operations. So they're trying to sidestep the distributive share point and say, no, it's just operations. And this is kind of goes to the tax court question. Oh, it's income from inventory. We don't need a deemed sale. Let's just look at it from the flip side. You need actual partnership operating income that generates distributive share income in order for this rule to apply. Whether it's the word attributable, that just doesn't magically create actual operating income. And I would say, just because now I'm going to be, my closing remark is, the word allocated is important. But guess what? The words would have been allocated is the actual verb. That's way more important than the word allocated. Would have been means it's not. We're going to calculate it as if it was, right? That's very different. So that's my point. There's no actual operating income here. If there were, it would be taxed as distributive share income. It will be taxed as distributive share income when it actually is realized.
Thank you. FTV, does that clarify?
Yes, thank you, Judge Lee, and thank you for that clarification. I was definitely going to take the long ride to the answer to that question. I very much appreciate that. Thank you, Mr. Campbell. So it was, there's two parts of that question. So when the partnership makes the sale, when I sell my interest, the partner sells their interest. That's the date of that sale. They're no longer receiving distributive share for future sales. So that's the first question. Will there potentially be double taxation between what happens in the residence and what happens in the state of California? Yeah, and that's what the other state tax credit is designed for. So ideally, that person in their state of residence says, you know what, I'm taxed on 100% by you. California just taxed the 751 portion of the income from my 13% that was apportioned of the sale of the overall gain. I would like another state tax credit for that. That's the device to do that. So that's in the other state's hands. There are a few exceptions when California would also give an OSTC to a non-resident, but I don't think for purposes of this they really matter. And then there's a second part, which is the step-up rules allowed under 704B that would step up the basis in the interest, and that's triggered at any time of the sale. So in some ways, that gain conceivably is evaporating.
Sorry, I can take that one. So just because it is really interesting. The 754 election is allowed anytime there's a sale of a partnership interest. So in this situation, the partnership could make a 754 election, and that would allow it to have the basis step up under IRC section 743B, and that prevents the double taxation from the buying partner. Thank you.
Thank you. Thank you both. No further questions.
All right, well, I believe this concludes the hearing, and I want to thank the parties for their presentations. Mr. Campbell, it looks like did you have something else, or? Okay. Thank you for your presentations. We will meet and decide the case based on the arguments and documents presented. We will issue our written opinion no later than 100 days from today. The case is submitted and the record is now closed. And we will take a brief recess before the next hearing, which is scheduled to begin at approximately 1 p.m. Thank you.